All right, y'all. Dual Economics. I'm Mike. I'm here with Cursor Crypto. We're gonna be talking today about and reacting to the FOMC Fed meeting with Jerome Powell for September of 2023. Kick that intro. We're gonna go ahead and jump right into it.
Cursive slang.
Welcome back. So without further ado, Jerome Powell.
Yeah, let's get it.
See what he's saying.
Let me hit play on here, bro. Give me 1 second.
And by the way, I think he's not. We're no interest rate hikes. That is my prediction.
In the last video we did, we said it was like a 98% that he chance that he win.
And Q1 rates next year, but with let's listen to Mr. Powell. Thank you, Greg. Focused on our dual mandate to promote maximum employment and stable prices for the American people. We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. We've raised our policy interest rate by 5.25 percentage points and have continued to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. Today, we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings.
That chart looked bad.
We're in a position to proceed carefully in determining the extent of additional policy firming that may be appropriate.
Just one day.
Our decisions will be based on our ongoing assessments of the incoming data and the evolving outlook and risks.
And the sell-off begins.
Monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a solid pace. And so far this year, growth in real GDP has come in above expectations. Recent readings on consumer spending have been particularly robust. Activity in the housing sector has picked up somewhat, though it remains well below levels of a year ago, largely reflecting higher mortgage rates. Higher interest rates also appear to be weighing on business fixed investment. In our Summary of Economic Projections, or SEP, committee participants revised up their assessments of real GDP growth, with the median for this year now at 2.1%. Participants expect growth to cool, with the median projection falling to 1.5% next year. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 150,000 jobs per month, a strong pace that is nevertheless well below that seen earlier in the year. The unemployment rate ticked up in August, but remains low at 3.8%. The labor force participation rate has moved up since late last year, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. The median unemployment rate projection in the SEP rises from 3.8% at the end of this year to 4.1% over the next 2 years. Inflation remains well above our longer run goal of 2%. Based on the Consumer Price Index, or CPI, and other data, we estimate that total PCE prices rose 3.4% over the 12 months ending in August, and that excluding the volatile food and energy categories, core PCE prices rose 3.9%. Inflation has moderated somewhat since the middle of last year, and longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Nevertheless, the process of getting inflation sustainably down to 2% has a long way to go. The median projection in the SEP for total PCE inflation is 3.3% this year, falls to 2.5% next year, and reaches 2% in 2026. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people.
Let me take that back just a little bit.
My colleagues and I are acute. Monetary policy actions are guided by our mandate to promote maximum employment. Projection in the SEP for total PCE inflation is 3.3% this year, falls to 2.5% next year, and reaches 2% in 2026. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we have raised our policy rate by 5.25 percentage points. We see the current stance of monetary policy as restrictive, putting downward pressure on economic activity, hiring, and inflation. In addition, the economy is facing headwinds from tighter credit conditions for households and businesses. In light of how far we have come in tightening policy, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings. We are committed to achieving and sustaining a stance of monetary policy that is sufficiently restrictive to bring inflation down to our 2% goal over time. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.6% at the end of this year, 5.1% at the end of 2024, and 3.9% at the end of 2025. Compared with our June summary of economic projections, the median projection is unrevised for the end of this year, but has moved up by 0.5 percentage point at the end of the next 2 years. These projections, of course, are not a committee's decision or plan. If the economy does not evolve as projected, the path of policy will adjust as appropriate to foster our maximum employment and price stability goals. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. Given how far we have come, we are in a position to proceed carefully as we assess the incoming data and the evolving outlook and risks. Real interest rates now are well above mainstream estimates of the neutral policy rate, but we are mindful of the inherent uncertainties in precisely gauging the stance of policy. We're prepared to raise rates further if appropriate, and we intend to hold policy at a restrictive level until we're confident that inflation is moving down sustainably toward our objective. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Would you go to one of them meetings?
Probably not, bro. They kind of quick, and I mean,
You know what I'm saying, bro? Like that's like a 10-minute meeting.
I mean, it was quick, but I mean, he's been saying the same thing for the past since they've been raising rates, and really since before then. So I kind of feel him on keeping it brief. Quick paycheck, collect that, and pew, pow.
Hey, is it something that can prevent them from not getting to 2%? Like, nah, we're not doing this 2%. You know what I'm saying? Or is it like, do you really think they like dead set on
I
just
think
2%?
they did set on 2%.
You think they are?
If it was to get above 2%, you end up having inflation. If it get below 2%, the currency really don't do well. That's kind of why they left the gold standard, because they need to inflate their way out of debt, bro. Basically, they need to be able to use the debt or the creation of money to as flexibility within the system, bro. So they got to keep it at 2%. Did anything from the video specifically like shock you, bro? And I think in the future we probably need to, well, at least me, I need to start keeping timestamps for when we start doing these. When I start taking my notes, so we can go back to those specific times in the video. But anything caught your attention, bro?
I mean, shoot, man. Him having to selling securities, man, from the balance sheet. You know what I'm saying? So like, he mentioned that, and we also mentioned that in the last weekly rundown video too, man. So I guess we're in the process. I guess because of this pause, I guess we're in the process of that happening right there, which should lead to markets dumping, man. And honestly, and I don't know, man, like from hearing Jerome Powell speak the past few months, not even past month, man, this year really, because I haven't missed a Fed meeting this year. It's looking like we're going to probably be in a recession all of 2024.
I mean,
not all of 2024, but I would say, because like I said, I don't think, because the Democrats hold office now, so I don't think that they don't want inflation to be high. They don't want people complaining about all of that stuff around election time. So I think going into election time, because election is November, so I can probably see us still being in a bear market, like markets down and whatnot, probably till like August, maybe August. Like August is when it's probably when like the bull market will start, because I got to get out of my head that, okay, as soon as 2024 hit, we going up. Like, nah, I don't know, bro. And if some bullshit was to happen, it would happen from right now, in between from now and August of next year. And I think August is when we're going to start seeing stuff start popping.
And I think that's the major thing that changed for me this video. I mean, this meeting. That right there, what you just said, what I believe for probably about the past few years, really since they popped this thing off, that it ended up coming to a head in 24, 25.
Yes.
That's what I've been believing for a minute. But
25 isn't like, in 25 is like, it's like, where we all want to cash out our cryptos at. That 2025 would be that.
What I'm saying is though, this meeting right here, this particular speech right here, changed my mind on that altogether.
No, it did. Yeah, it did for me. Listening to what Jerome just said, bro. Like, yeah, because we may get back down to 2%, and we ain't gonna get to 2% next year. We're not gonna get to 2%. We're not gonna get to 2% next year. You know what I'm saying? So it's like, so really, maybe the next 2025, maybe, 2025, maybe possibly going into 2026.
This is what I got from the video, bro. This is the biggest thing that
it's changed my time frame, though. It's changed my time frame for sure. I don't feel rushed. Like, I don't feel rushed to do, to make moves right now because of what he just said. You know what I'm saying?
I agree with that. I agree with that also. I can definitely wait a while for some things. But this is what changed for me with this video. And let me see if I can go back and find it right. Because I think this was the most important thing that I heard him say in probably a minute. Let's see here if I can find it.
Median participant projects that the appropriate level of the federal funds rate will be 5.6% at the end of this year, 5.1% at the end of 2024, and 3.9% at the end of 2025. Compared with our June summary of economic projections, the median projection is unrevised for the end of this year, but has moved up by a half percentage point at the end of the next 2 years.
Bang. See how he slipped that bomb in there? And it's done in a way where you really can't understand what he said. So he said that the projections for the end of this year were 5.6%. We at 5.25 to 5.5% right now as far as interest rate. So that's an increase of not, depending on how you look at it, it could be an increase of 0.25%, or it could just be an increase of 0.1%, depending on however you look at it. Because we're getting to 5.6 from 5.25 to 5.5.
Mm-hmm.
So that's not the crazy thing about it. He said that originally they said that by the end of the next year, they felt that we would end up getting to 5.1% by the end of next year.
Yeah, I remember that. I remember he said that. And then he said like 3.
Hold on. Let me finish, bro. Which would mean that rate cuts would be coming next year. And he also said that they originally felt that they would get to 3.9% by the end of 2025. He came back and said now they're adjusting that to it still staying the same for this at the end of this year, which is still 5.6%. He said for the latter 2 years, they felt that it should be a half percentage point increase for both. So that's 0.5 increase for both years. So that means for the end of 24, going from 5.1 to 5.6%. And that means at the end of 2025, going 3.9, going from 3.9 to 4.4. The thing about that is if we're at 5.6 as far as percentage rate, the rate percentage, if we're at 5.6 at the end of this year, and we're also at 5.6 at the end of 2024, that means that they're not planning to do no rate hikes for none of 2024. Not wait until August. I thought that they would probably pause for about maybe 6 to maybe 9 months. But based off of what he just said, they're projecting to have interest rates. And I'm gonna play this again. I want you to correct me if I'm wrong. He just said that they're projected to have interest rates expected to be 5.5% at the end of 2023 and at the end of 2024, which would be a change of 0%.
Which means that we shouldn't see no more cuts until we shouldn't see no cuts. We shouldn't see no cuts for the rest of this year, nor for the rest of next year either.
So that means that everything that's going on with housing on market rates, everything that go on with car rates, all that stuff, he's saying gonna stay high.
It's gonna go on for another whole entire year.
Over a year, because it's September.
So it's September now. So it's like they got a year and some months.
And I'm gonna play this one more time because I want to make sure
He's just gonna let it sit. He's just gonna let it sit and ride for the whole year.
Correct me if I heard anything wrong.
Dang, bro, that's gonna be bad.
He just dropped it. Like you could barely really even I'm just gonna.
Economy evolves as projected. The median participant projects that the appropriate level of the federal funds rate will be 5.6% at the end of this year, 5.1% at the end of 2024, and 3.9% at the end of 2025.
He said 5.1.
Compared with our June summary of economic projections, the median projection is unrevised for the end of this year, but has moved up by a half percentage point at the end of the next 2 years. These projections
Did you hear it?
Yeah. Yeah.
So
When is the money printer coming back on then?
that mean it won't come back on until at least 2025. Now check this out, bro. That means that if you were every investor that got a lot of money that's worried about stocks, if they just want to be safe, they can just go hop into 5% and CDs, treasury bills, and stuff like that. So you finna have a lot of money swooping out of that stuff because they know that he just said that these rates gonna be locked in for at least a year. That's what he basically just said, bro.
Mm-hmm.
So I wouldn't be surprised if stocks catch it. And me and you both know that they still are selling off their balance sheet. He just said it.
Mm-hmm.
So if they're not taking the interest rate up, and they're trying to get down to 2%, and if they're not taking the interest rate up, they're cutting the balance sheet. When they first started, they said that they'd cut at a max of $75 billion a month. I'm willing to bet that they're gonna hit that max now that they're not touching the interest rate, bro.
Mm-hmm. Yeah.
They're trying to cut back about $3-4 trillion. So we're talking basically $100 billion a month. 10 months would be $1 trillion. Technically, we need to do this for 30 months.
We need to do this for 30. We need to be doing this, what we're doing now, for 30 more months.
No, basically we need to be doing this for 30 months, bro. Technically, which is what, like 3 years? Almost 3 years? 2.5, basically.
Mm-hmm. Mm-hmm.
Did you have anything that you want to share as far as charts?
But this, as far as what now?
Like charts or anything. I know I had 2.
Nah, man, but I'm telling you this, man, like, man, if y'all paying attention, to this, really, man, you can be set up for the rest of your life in 3-4 years, bro. In 4 years, you can be set up for the rest of your life. Really. Man. And they're selling off. They're selling off assets also. So that's also more liquidity leaving the markets, man.
All right, can you see this, bro?
Yeah.
Let me pull up my screen because I want everybody to see what I got right here. So the red that you see is the S&P 500. The blue line that you see is the balance sheet for the Fed. These are not actual amounts. This is like percent change from year to year. This is a percent change. You know what I'm saying? Mm-hmm. So if you notice, anytime, before I even say that, in our last video, we talked about how the Fed is one of the biggest purchasers and sellers of stocks, right? Because if something bad happens, they'll step in and purchase to even out the market. If the market's going too crazy, they'll step in and sell to kind of even out the market. So if you notice the blue line, which is the Fed, anytime the percent of their balance sheet goes up, anytime they have more money on their balance sheet, later on, the stock market, which is, I have the S&P, which is the stock market generalized top 500 companies. Anytime the Fed, the blue line goes up, the red line goes up later as a what's the word? It's basically like as an after effect of the blue line going up as a result of the Fed putting in more money. The stock market,
the red line goes up.
And when you see when the government has to reduce their balance sheet or sell assets, the stock market goes down later. If you look at the chart towards the very right end, let me see if I can switch screens. If you look at the chart right up in here, you notice that there's a divergence. The red line, which is the percentage increase for the stock market, is not matching the blue line, which is the decreased percentage for the Fed balance sheet. So being that the Fed is reducing its balance sheet or selling assets, you should now expect this red line, which is this percent change in the stock market, to decrease as the Fed pulls their funds out of the stock market. So we should start seeing this red line begin to dip soon because this blue line is increasing a lot.
That's a death cross.
And if you go back right here and look at 2020,
you can see it. You can. Ooh, that's consolidation right there, man.
that change in the balance sheet went crazy. So that percent change in the balance sheet has to be undone, which means that we're more than likely going to stay in this blue area for a minute. So this red line should be coming down for the minute, which is the percent.
Hey, what? Go back to that. Go back to that page. I need. Hold on. Let me type this. I want to type this URL in right here, man.
That's the Fred website. You can look up everything on the Fred website.
Fred.Saint.
The Fed balance sheet is there. The interest rates are there. The mortgage rates are there. The bond yields, 2-year, 10-year, all that stuff is on the Fed balance on the Fed website, bro.
Series.
We need to start.
I'm adding this, bro. I'm adding this into my. I'm definitely adding this into my arsenal of indicators to look at, bro. Because you can track this chart, right? You can track this chart right here, man, and you can see like even when this little cross happened, even when that cross happened right there before they started putting money back in there, like it's going, man. This is power. That's a powerful tool, man.
We need to put a section in the description called Arsenal of Indicators.
Yeah, because it looks like when they crossed, so at the end, at the far right, where it's crossing at, while they're trying to bring that blue line up, and as they're bringing that blue line up, that red, the red, that's the S&P, right?
Right now, they are not trying to bring that blue line up.
That's what I'm saying. That's what I'm saying. So
Jerome Powell in the meeting just said they're not trying to bring the blue line.
So you see them consolidation points on the S&P, them deep dips down.
Mm-hmm.
So we can possibly be going back down now, man.
Yeah,
the S&P could possibly be going back down to them levels right there. So then I'm just thinking about that, and I'm like, okay, dang. So what could Bitcoin possibly do? You know what I'm saying? Like, I wonder if you can put this if you could take the S&P out and put like the Bitcoin chart right there and see how the Bitcoin is. You see what I'm saying?
Let me see.
Like if you could if you could take out like that red line, that's the S&P. I wonder if you can get like
I would imagine that Bitcoin would probably follow
because as you're going through this, I'm thinking, okay, what do I think Bitcoin will do?
I'm thinking Bitcoin should diverge from the balance sheet. From the S&P 500 technically, and I feel like if the balance sheet increases, Bitcoin should increase because if the balance sheet is going up and the government is buying more and spending more money on assets.
That's what I'm saying. Then more than likely, the price of Bitcoin will probably be going up too. So
let me see if I can take the S&P 500 off and put Bitcoin.
You see what I'm saying? Like that's, I wonder if you can put any asset right there. But it would be cool to see how that
you can't put any asset. Let's do Coinbase Bitcoin. So I guess it's Bitcoin prices based off of Coinbase. Let me add this on. I think I was doing it as a percent change. I want it to be a percent change.
See, oh, there it is right there.
So Bitcoin really ain't got no correlation to this.
It doesn't, you think?
It ain't been long enough it ain't been long enough to at least see one. It ain't. I mean, it's two spikes. It's a spike while it's going down. It's a spike while the blue line going up.
Yeah, it is, and those are huge spikes too.
Yeah, it really ain't no correlation.
Okay, well, I guess that's good to know.
The only thing I see on here is as far as the percent change, and let me make sure I'm looking at the right one.
That's good to know. Oh man, so what? So the crypto market actually, according to this, it may not have. Hopefully, it doesn't have that effect on.
Okay, here we go. So the only thing that I'm really noticing on this chart is every time crypto rise and fall, it normally forms like a perfect head and shoulders pattern.
Yeah, you see it.
A lot of shoulders on it. You know what I'm saying?
Mm-hmm.
It looks the same every. Yeah, it'll fall the same way. Then it'll rise.
Those volatility spikes are just look crazy, man. Like
it is crazy.
That's not a standard. That's not how a standard chart looks, though.
Nah, bro. I mean,
like you know what I mean. I wonder throughout the years, once crypto starts getting more adopted, if the crypto charts will start to look more like stock market charts.
I think once they get more stable. But bro, I think we kind of then finished talking about the FOMC meeting. So I think we can go ahead and wrap this up. Anything else you want to say in regards to that one?
Shoot, hey man, this is probably one of the more informative, important videos that we've done, man. This is
definitely
for real, man. Y'all need to go back and watch this one because this can really. I'm telling you, bro, man. If all you have to do is go to that Fred chart, even with the S&P, and you can, bro, based off of that, you can use that as a trading indicator, bro, and just trade that shit. Take a look at the chart every day. You know what I'm saying? You go back to the I guess the one with the S&P, and honestly, bro, that's probably how most of these dudes be trading it, man. Like they probably don't be going through making all those graphs and charts, putting lines everywhere. You know, they probably just follow that.
A lot of folks go straight to the Fred website.
You know what I mean? They probably just follow that one, that one indicator. You know what I'm saying? And it's probably the more effective indicator too.
Look at these
so.
Pictures. Yeah, bro. So we can go on here. You can kind of change up the formulas, kind of get used to it. You know what I'm saying? I went to the percent change earlier. It's kind of what I had did. Percent change. I was doing it earlier with the Fed balance sheet. This is the Fed rate.
That's 3. Say so. CPI for all urban consumers, all items. Hey, I got some CPI data also, man. I had so they said headline inflation for August is 3.7%, which is up 3.2 from July. So they said, let's see, energy is down 3.6 year over year. July to August is up 5.6%. Gas is up 10.6% the past month.
Ain't gonna go up some more.
I ain't gonna lie to you, bro. Like, I'll be finding myself. I spend more time in the gas station than I do at work, but
I want to look at this.
They milking us.
What's the Russian oil thing called?
Mm-hmm.
What's the Russian oil? Euro.
The Russian what currency?
No, the Russian oil. I think it's called a euro. Let's pull up the euro chart right quick.
Euro, okay.
The euro chart is basically on them and OPEC, they're basically leading oil prices right now. So I want to see if I can pull up a euro chart just to get an idea of what oil price is about to go, since they say it's up 10%. It's probably up going up another 10% this month. Look at this chart.
Sheesh.
I ain't saying it's gonna stay up there. You know what I'm saying? The past, unless they predict the future on charts, but that's a nice little zooming up pattern right there. I'm talking about.
Man. Look at that.
And they talking about cutting supply, so I'm expecting this to go up a little bit more.
Hey, do you think with them keeping interest rates at this percent, especially going through all next year, you think that's going to be a driver for mass unemployment?
I think first of all, unemployment, interest rates being high is going to cause people not to be able to afford things, or either cause people to be on a tight budget. And I think certain businesses are going to end up making less money because of the higher interest rates, the higher cost to borrow money. And I feel like as a result, they might have to lay off people. And if people get laid off and prices remain high, it might affect a few things. So I feel like that's going to be an issue. And I don't think a lot of people paying attention to what's going on to the Panama Canal drying up right now. It's a lot of ships and stuff starting to get backed up, just like they was getting backed up with the Suez Canal a few years ago. So a lot of shipments starting to go up in price. So, you know what I'm saying?
Yeah. Because the low wages and inflation on food, I guess household expenses, and like housing, shelter price.
Yeah, bro.
That probably could contribute to like a little housing crisis or something like that. Yeah. I don't know. We'll see. That could be the real estate crash. So, but yeah, man. But shoot, that's about it, bro. That's about it.
All right, y'all. Well, this dual economics.
Please subscribe to the channel.
Definitely subscribe. I want to give y'all a hint to a video that I'm gonna be doing soon.
Hit the like button.
I have a nice little silver show. Most of the time, you can't see the silver coins when you're showing them all that well. You got to focus real hard on them. Let me see if I can zoom in. You got to focus like real hard on them. Like, actually, it's kind of working right now. This is cool. That's why I get these protective cases to make sure y'all get these. But I also got the one with the antique finish that you can kind of see. And originally, I wasn't a fan of the antique finish, but now that I have it,
that antique finish that thing feel good in your hands.
Not even just that, bro. You can get in and kind of see the detail better. Like, it's hard to see this, even if you're looking at it on camera. But you can see all the details, all the little crevices. You know what I'm saying? You can see all the layers of the detail with the antique finish. So I got something with these coming. What they are, where I got them from, I guess you can kind of see them if you look close enough to the coins. But be on the lookout for that, y'all. I'll see y'all in the next one. We out. Oh, shit. Let me make sure they can see you on the way out, too, bro. Shit, curse some crypto. Anything you want to say before we go, bro?
Nah, man, we up out of here, man. Y'all be on the lookout for these next videos.
And who the Falcons gonna lose to this Sunday?
Nah, bro, who we beating? who we beating? We beating the Detroit Lions, man. I give you that one. We got the Lions on Sunday, but I mean they've been playing pretty good, man. They 2-0. I think they 2-0 too.
Yeah, all the trash teams still.
Man, bro, look, look, you got to watch B. John Robinson run this football, man. It's.
I'm gonna definitely check. We're gonna check them out.
They did. I guess it was a pass or so, bro. Buddy came. He was like, he did like a little Spider-Man move. So man, he did like a little Spider-Man move. Juked him, ran up, juked him. I'm like, this dude for the touchdown. I'm like, this dude is insane. Like, bro, because I want to sack the quarterback, bro. I want to sack the quarterback. That's what I want. I want us to get offensive linemen, and I want us to sack the quarterback. So I was like, why are we getting a running back I take that back though, because this dude can play, bro. He can run that thing. I was like, okay, all right, fine, Falcons. I agree. I agree.
All right, y'all. We're going, like I said,
All right, y'all.
All in the next one.
Yes, sir.
Cursive slang.